Texas just ranks 7th in the nation for the highest property taxes. Mortgage rates hit their lowest level since September of 2022. Congress passed a major housing bill by a vote of 390 to 9, and a Florida-based developer just got approved to build more than 13,000 homes in Waxahachie. Welcome to Jesse's weekly DFW real estate update. I'm Jesse Showalter. Let's get into it. We've got a lot to cover this week. Let's start with what's happening here locally. Our first story is one every homeowner in Texas feels. Wallet Hub released its annual property tax report on February 17th, and Texas now ranks 7th highest in the nation. The median property tax bill for a Texas homeowner is $4,232, up $360 from last year. That's based on a median home value of $283,800. We all know Texas has no state income tax, but property taxes are how the state makes up that revenue, and the burden is growing. Here's why this matters beyond just the headline. Property taxes directly affect your monthly payment. When a buyer is figuring out what they can afford, it's not just about the rate and the price. It's about what the total payment looks like after taxes, insurance, HOA, and any special assessments. And in Texas, that tax line is one of the largest in the country. For sellers, rising taxes compress what buyers can offer on your home. Their purchasing power goes down, which means pricing accurately matters even more. If you're a homeowner, make sure you're reviewing your appraisal every year and protesting if the numbers don't match what comparable homes are actually selling for. That's the most direct way to manage your tax bill. If you need help with that, reach out. Next, a story flying under the radar that could affect some of the more established neighborhoods in the Metroplex. As enrollment declines across certain DFW school districts, closures are creating something developers have been looking for in built-out cities for years: available land. When a school closes, what's left is often a well-located property on a major road with water, sewer, and road access already in place. In mature suburbs where buildable land is scarce, those sites are attracting serious interest from residential and mixed-use developers. If you live near a school site that's closing, pay attention to what gets proposed. The right kind of redevelopment can add value to the surrounding area, but it can also create pushback depending on the density and design. For buyers, this is worth watching. Some of the best located new housing in DFW over the next few years may come from those infill sites in neighborhoods that are already established with mature trees, existing retail, and proven school zones. That's a very different product than building on raw land 45 minutes to an hour out. Our third local story brings some encouraging data for buyers. Zoocasa recently analyzed year-over-year price changes across 20 major cities in the South. Dallas came in at number 2 for the largest affordability improvement, behind only Naples, Florida. The median single-family home price in Dallas corrected 5.71%, dropping from about $398,000 to roughly $375,000. Now, this is not a crash. This is more of a normalization. After years of double-digit appreciation that priced a lot of people out, the market is coming back to earth, and that's healthy. For buyers, real affordability gains are happening right now. Homes are sitting longer, sellers are negotiating. When you combine that correction with the rate environment we'll talk about here shortly, the math on buying in DFW is more favorable than it's been in years. For sellers, the takeaway is simple: price it right from the start. The days of listing 5% above market and waiting for someone to pay it are behind us. Sellers who price accurately and present well are still getting offers. The ones who aren't are sitting. What's happening locally is being shaped by what's going on at the national level. And this week, we have 2 major policy stories worth paying attention to. On February 9th, the U.S. House passed the Housing for the 21st Century Act by a vote of 390 to 9. That's about as bipartisan as it gets right now. This is H.R. 6644, a comprehensive housing bill led by Chairman French Hill and Ranking Member Maxine Waters. So what does it actually do? It's designed to address the national housing shortage by making it easier to build and finance housing. Here are the key pieces. First, it directs HUD to develop model policies that state and local governments can use to expand housing supply. Think of it as a federal best practices playbook for removing barriers to building. Second, it streamlines environmental reviews for infill and mid-sized residential projects. Less red tape, faster construction timelines. Third, it adjusts multifamily loan limits and ties them to a construction cost index. Current caps haven't kept up with what it actually costs to build apartments today. Fourth, it modernizes manufactured housing by eliminating the outdated requirement that manufactured homes be built on a permanent chassis. That opens the door to more innovative, affordable construction methods. Fifth, it gives community banks more flexibility to finance housing projects in their local markets. The bill still needs to be reconciled with the Senate's version, the Road to Housing Act, which passed committee unanimously last year. So there's more work to do before anything lands on the president's desk. Here's why it matters. We don't have enough homes. We haven't built enough for years, and regulation has made it harder and more expensive to build. This bill is Congress acknowledging that and taking real steps towards fixing it. Will it affect your next transaction? Probably not. But the direction is right, and 390 to 9 tells you there's real will behind it. Staying in Washington at the MBA Servicing Conference this past week, leaders from FHA, VA, and Ginnie outlined their 2026 priorities. On the FHA side, the focus is on streamlining the lending process, faster loan processing, and less friction for FHA buyers. On the VA side, a partial claims program is coming soon. If a borrower falls behind on payments, instead of facing foreclosure, they'd be able to defer missed payments to the end of the loan. That's a real safety net, and it makes the VA loan even more attractive. And Ginnie Mae is shifting to a loan-level risk management model. That's more behind the scenes, but it's designed to improve the long-term stability of the programs millions of Americans depend on. If you're a veteran or active duty service member, the VA loan remains one of the best products available. Zero down, no PMI, and now an added safety net. If you're not sure whether you qualify, talk to your lender. It's worth checking out. Now let's talk rates, and I've got a slightly different format for you today. I'm going to hit the highlights and then hand it over to the man himself, my lender partner, Mortgage Mike, Michael DeBacker, who always brings the knowledge in Mortgage Mike's monthly update. As of Friday, February 21st, when this video is being recorded, the average 30-year fix sits at about 6.05% according to Mortgage News Daily. The big headline this week, Freddie Mac's weekly survey came in at 6.01%. That's the lowest weekly average since September of 2022. A year ago, the 30-year was at 6.85%, so we're down significantly. The 15-year fixed is at 5.35%, and refi activity has more than doubled year over year. For buyers, this is the most favorable rate environment in over 3 years. When you pair these rates with builder incentives and the price corrections we've been talking about, the affordability picture is at the best it's been in a while. Now, for a deeper look at what's happening in the mortgage world, I want to bring in Mortgage Mike. Mike, take it away.
My name is Michael DeBacker, and I'm with the Mortgage Mike Group, and I'm here to talk about what's going on in the mortgage world and news to pay attention to moving forward. So we did receive the Federal Reserve's minutes this week, and what they reveal is the central bank is really caught kind of in a delicate balancing act, shifting their focus from strictly fighting inflation to protecting the labor market. While officials acknowledge that inflation is finally cooling towards their 2% target, they did express a clear kind of wait-and-see attitude, signaling that they aren't in a rush to slash interest rates just yet. The committee remains weary of a second wave of price hikes in the service and housing sector, meaning the higher for longer mantra hasn't entirely disappeared. However, for the first time in months, there's a growing concern that the job market might be cooling too quickly, which could force their hand sooner than expected. For investors and consumers, the bottom line is a hawkish hold. The next move is likely a cut, but don't expect a rapid fire return to the era of cheap money until the economic data shows more of a definitive trend. And so we're still going to be in a bit of a holding pattern to see what the financial reports tell us in the coming weeks. That's really going to indicate the direction that the Fed is going to be moving into. So anytime you have any questions, please feel free to reach out. Always happy to help.
Mike, thank you. Great information as always. If you want to connect with Mike directly, his information are in the show notes below. Now, let's get into our construction spotlight, and this one is a major story. We're heading south to Waxahachie. On January 28th, the City Council voted 3-2 to approve zoning for a master plan community by Minto Communities USA, a Florida-based developer with over 45 years of experience building large-scale residential communities. The development spans almost 3,200 acres west of Waxahachie. It's approved for over 13,000 homes. Let me say that again, over 13,000 homes. That breaks down to 11,880 single-family and 1,390 multifamily and mixed-use units. The mix includes traditional single-family, villas, cottages, townhomes, apartments, and 55-plus active adult neighborhoods, along with commercial space, schools, parks, and community amenities. To put the scale into perspective, this community could house about 33,900 people. Waxahachie's current population is around 52,000. So a single development could grow the city by 65%. The economic numbers are big. The city estimates $42 million in annual revenue, a $4.8 billion tax base for Waxahachie ISD, generating $56 million a year in school revenue. Over 2,000 construction jobs during build-out and 7,500 permanent jobs from commercial and retail over time. Construction is expected to start mid-2026. The site sits west of I-35E, south of FM 875, north of FM 1446, and east of Lone Elm Road. What's notable about Minto is that they own the land, develop the property, and build the homes. That vertically integrated model gives them a lot of control over quality and pricing. The vote was 3-2, so not unanimous. The mayor and one council member voted against, citing concerns about details not being finalized. But the majority saw the long-term economic upside. And this isn't the only large development in Waxahachie. Myrtle Creek, a 1,260-acre community nearby, is already selling homes from the 300s to 800,000s with 2,500 planned units. Add it all up, and Waxahachie could see more than 15,000 new homes between these two developments alone. That's a fundamental shift for Southern Ellis County and the I-35E corridor. For buyers, Waxahachie is about 30 miles south of downtown Dallas. Lower cost of living, strong schools, a great historic downtown, and increasingly real new construction options. If you've been looking north and west and feel priced out, it might be time to look south. Links to Minto and Myrtle Creek are in the show notes. Now it's time for Jesse's real estate tip of the week, and this one ties directly into the property tax story we opened the show with. If you're buying new construction, make sure you understand what your full monthly payment is going to be once property taxes catch up to the actual value of the home. Here's what happens. When you close on a new build, the county appraisal district may still be taxing the property based on the vacant lot, not the finished home. So let's say you buy a new home for $350,000. At closing, the tax office might still have it assessed at $40,000 or $50,000 for the lot. Your escrow is based on that lower number. Your monthly payment looks great. Then the appraisal district catches up. They reassess the property at or near your purchase price. Your tax bill doubles or triples. Your lender runs an escrow analysis, finds a shortage, and your payment jumps $300, $400, and sometimes $500 or more. This isn't a lender mistake. It's not a builder bait and switch. It's just how the system works. The appraisal district doesn't always have the improved value on file when you close, especially on homes that were just completed. Here's what to do. Before you sign a contract on new construction, ask your lender to run the payment using the projected assessed value of the finished home at the full tax rate, not whatever the tax office currently shows for the lot. Your lender or your agent, me, can pull that number for you. And remember, in a lot of new construction communities here in DFW, you may also have PID or MUD assessments. They fund roads, water, sewer, and infrastructure in the development. Two homes at the same price can be $300 to $500 apart per month, depending on location and tax district. I see it all the time. And here's why this is getting more attention right now. Texas has actually strengthened its disclosure laws in recent years. Sellers are now required to provide specific notices to buyers before the contract is signed if a property is in a MUD, PID, or PUD. Those notices have to include detailed information about tax rates, assessments, and bonded indebtedness. And if those notices aren't provided, buyers have the right to terminate the contract or pursue damages. So the protections are there, but you have to know what you're looking at. On top of that, there are active lawsuits right now against major national home builders alleging that their affiliated lenders deliberately used the lower vacant lot tax numbers on loan documents to make monthly payments look more affordable than they actually were. We're talking about buyers whose payments jumped $500, $800, or even over $1,000 a month once the real tax bill hit. Those cases are still working through the courts, but they highlight exactly why this matters. Bottom line, don't fall in love with the first payment estimate. Make sure you know what that number is going to be once the full tax picture is in place. That one step will save you a lot of frustration, and if you're not sure how to calculate it, that's what I'm here for. That's it for Jesse's weekly DFW real estate update for the week of Monday, February 23rd. If you found this helpful, please like, subscribe, and share. And if you're thinking about buying, selling, or investing in real estate in North Texas, I'm always happy to be a resource. Let's have a conversation. I'm here when you're ready. I'll see you next Monday.